60 days. That is all the time left before the most consequential trade negotiation Canada has faced in a generation reaches its first major checkpoint. 60 days until the CUSMA review deadline of July 1st. And this week, something happened that most analysts are still struggling to place inside the right frame. On Monday, April 28th, Shell plc signed a binding agreement to acquire ARC Resources, a Calgary-based natural gas producer, in a deal valued at $22 billion. The purchase price came in at $32.80 per share, a 27% premium over ARC's closing price just days earlier. $22 billion, a 27% premium from one of the most disciplined, most sophisticated energy investors on the planet. That is not a routine corporate acquisition. That is a signal. Now, I want to be precise about something before we go any further. I am not here to tell you this deal single-handedly reshapes North American politics overnight. What I am here to do is help you read what this signal actually means layer by layer, because the surface story and the strategic story are two very different things. Here is what we are going to unpack together. First, what Shell actually bought and why the asset matters far beyond its production numbers. Second, the external variable that almost nobody is connecting to this deal, a disruption thousands of miles away that is quietly redirecting billions of dollars in global energy demand. And third, what all of this means 60 days out from a negotiating table where Canada's economic relationship with the United States is being renegotiated in real time. 3 layers. Each one changes how you read the one before it. Let's start with the deal itself. Let's talk about what Shell actually bought. Because the headline number $22 billion only makes sense when you understand what sits underneath it. ARC Resources is a Calgary-based natural gas producer. Last year, its operations in the Montney Formation produced 374,000 barrels of oil equivalent per day. The transaction is structured as 75% Shell shares and 25% cash at $32.80 per share. Regulatory and shareholder approval is still required. The deal is expected to close in the second half of 2026. Now, what is the Montney Formation? It sits across northeastern British Columbia and northwestern Alberta. It is one of the most productive shale gas regions on Earth. Not productive by Canadian standards, by global standards. Tom Pavick, president of Sayer Energy Advisors in Calgary, described it as a world-class resource with attractive economics. That is the language energy professionals use when they mean something is genuinely exceptional. Before this acquisition, Shell was the 7th largest producer in the Montney. After it closes, Shell moves to number 2, behind only Denver-based Ovintiv. That jump from 7th to 2nd tells you how significant ARC's holdings are. Shell did not pay a 27% premium to move up 2 or 3 positions. It paid that premium to vault itself into a completely different tier of the market. But here is where I need you to stop and think about something. Shell already owns 40% of LNG Canada. That is the liquefied natural gas export terminal in Kitimat, British Columbia. It began operations in 2024. It is Canada's first ever LNG export terminal. The other partners in that consortium are Japanese, Malaysian, Chinese, and South Korean companies. Read that again. Japanese, Malaysian, Chinese, South Korean. Asia already has direct financial skin in Canadian energy infrastructure. This is not a future possibility. It is an existing reality. Now connect the two pieces. Shell acquires a massive Montney gas producer. Shell already owns 40% of the terminal that converts that gas into liquefied form and ships it to Asia. What Shell has just done, according to Andrew Dittmer, principal analyst at Enverus Intelligence Research, is secure a long-term upstream supply chain to feed directly into LNG Canada. Dittmer's assessment is worth quoting carefully. He noted that Shell's interest in LNG Canada is an important strategic component of the deal, and that LNG Canada is geographically advantaged for shipping to Asian markets, giving it a competitive edge over United States Gulf Coast competitors. I want to be precise here. This is analyst interpretation, not confirmed corporate strategy. Shell has not publicly declared this deal is designed to serve Asian markets specifically. But the structural logic is difficult to argue with. Gas drilled in Alberta and British Columbia, piped west through the Canadian Rockies, chilled into liquid form at Kitimat, loaded onto tankers, shipped to Japan, South Korea, and China. That is a complete vertically integrated supply chain, from wellhead to tanker, on the Pacific coast, pointed directly at the fastest growing energy markets in the world. And Shell just paid $22 billion to control a critical piece of it. That is the deal. That is what was actually bought on Monday. But there is a variable I have not mentioned yet, one that was not created by Shell, one that was not created by Canada, and one that is making every number in this story significantly more valuable than it was 12 months ago. Here is the variable nobody put in the press release. While Shell and ARC were finalizing a $22 billion agreement in Calgary, something was happening on the other side of the world that was quietly rewriting the economics of every LNG project on the Pacific coast. Let me give you a piece of geography first. The Strait of Hormuz is a narrow waterway connecting the Persian Gulf to the Gulf of Oman. Roughly 20% of the world's liquefied natural gas passes through it. 20%. That is not a marginal figure. That is a structural dependency that dozens of countries have built their energy planning around for decades. Qatar is one of the 3 largest LNG exporters on the planet. For years, buyers across Asia, Japan, South Korea, China, Taiwan built their supply chains around Qatari gas routed through the Persian Gulf. It was reliable. It was established. It was the system. That system is now under pressure. Ongoing conflict in the Middle East has created sustained uncertainty around the Strait of Hormuz. As of this week, the situation remains unresolved. I want to be careful here. The precise operational impact on Qatari production is still being assessed by independent analysts, and I will not overstate what has been confirmed. What is confirmed is this: the Strait of Hormuz is under geopolitical stress, and that stress is measurable in global LNG pricing. Analysts at CIBC World Markets published a report last week stating that Canadian LNG projects look increasingly attractive amid the conflict, given Canada's relatively low geopolitical risk. Their specific framing was that the situation highlights the advantages of Canadian LNG as a reliable provider from a stable jurisdiction with proximity to Asia. That is not cheerleading. That is risk assessment from a major financial institution. Now, let me translate what that actually means for a buyer in Tokyo or Seoul sitting with an energy procurement contract that routes through the Persian Gulf. You are not just buying gas. You are buying a supply chain. And right now, one of the world's most critical choke points for that supply chain is unpredictable. Your government is asking you hard questions about energy security. Your answer, until recently, was Qatar. That answer is now complicated. Canada offers something different: a stable legal jurisdiction, a majority government in power until 2029, a terminal on the Pacific coast with no strait to blockade, a shipping route to northeastern Asia that geographically is shorter than the route from the American Gulf Coast. That last point matters, and I want to state it carefully. The geographic advantage of Kitimat relative to Gulf Coast terminals for Northeast Asian buyers is a structural reality based on shipping distances. It is not a political claim. It is a map. Here is what I find significant about the timing. Shell signed a $22 billion agreement on April 28th. LNG Canada Phase 1 is approaching full operating capacity right now in May of 2025. And the world's second largest source of LNG is navigating a period of serious supply uncertainty. These 3 things did not cause each other, but they are converging at the same moment. And 60 days from now, Canadian negotiators will sit across a table from their American counterparts with all three of them in the room. That brings us to the part of this story that requires the most careful reading. Let me put a number on the table before anything else. 60 days, July 1st, 2025. That is the CUSMA review deadline. The Canada-United States-Mexico Agreement contains a formal joint review mechanism that requires all three parties to confirm their intent to continue the agreement or signal that renegotiation is needed. This is not an expiration date, but it is a pressure point, and both sides know it. Now let me decode something for you. When Canadian Energy Minister Tim Hodgson said publicly that he wants Canada's energy and natural resources sectors to play the strategically important role they should be playing as Canada's strongest cards in the CUSMA renegotiation, what did he actually say? In diplomatic language, that sentence sounds like policy ambition: reasonable, measured, forgettable. Here is the translation. Canada is formally signaling that energy exports are on the table as a negotiating instrument, not as a threat, as a declared position. That is a meaningful distinction. A threat is destabilizing. A declared position is a negotiating stance. What Hodgson did was establish publicly and on record that Ottawa intends to use energy interdependence as leverage in a trade conversation. That is not speculation. That is the Minister of Energy saying it out loud. Now let me give you the numbers that sit behind that position. TD Bank analysis estimates that without Canadian energy exports, the American trade surplus with Canada flips to a deficit of approximately $45 billion. I want to be precise, this is a modeled estimate, not a realized figure. It reflects a hypothetical scenario, but the directional logic is grounded in real trade flows. Canada supplies roughly 25% of American crude oil imports. That is a verified figure from trade data. Ontario alone provides electricity to approximately 1.5 million homes across Michigan, Minnesota, and New York, also verified. These are not abstract statistics. They are the physical infrastructure of North American energy interdependence. They exist whether or not either government acknowledges them publicly. Here is where the Shell deal enters the diplomatic calculation, and I want to be careful about how I frame this. Shell's $22 billion commitment does not directly strengthen Canada's legal position at the CUSMA table. Trade agreements are not renegotiated based on private sector deals. That is not how the mechanism works. But here is what it does do. It creates political context. When a government is sitting across a negotiating table arguing that its energy sector is strategically valuable, and one of the world's most analytically rigorous energy companies has just paid a 27% premium to acquire Canadian gas assets, that is not irrelevant. It is corroborating evidence for the position Ottawa is already arguing. It also changes the domestic political calculus. A government that can point to $22 billion in foreign direct investment while simultaneously negotiating trade terms is operating from a different posture than one that cannot. There is something else worth noting, and I think it is underreported. The LNG Canada Consortium already includes Japanese, Malaysian, Chinese, and South Korean partners. These are not passive investors. They are governments and state-linked energy companies with their own foreign policy interests. When Asian partners have capital deployed in Canadian infrastructure, the conversation about Canadian energy reliability is no longer a bilateral Canada-United States conversation. It has multilateral dimensions. I am not suggesting a coordinated strategy among these parties. I have no evidence of that. What I am observing is that the structure of interests around Canadian LNG is broader than any single trade negotiation. Now, what are the limits of this analysis? CUSMA negotiations are not public. We do not have access to what is actually being discussed. The outcome is genuinely uncertain. A $22 billion deal does not guarantee a favorable trade outcome. Energy interdependence can be acknowledged by both sides and still result in a difficult negotiation. What we can say, based on verified data and on record statements, is this. Canada enters the 60-day countdown with a documented investment signal, a declared negotiating position from its own energy minister, and a set of trade flow figures that make the energy interdependence argument substantive rather than rhetorical. Whether that translates into outcomes, that is the question nobody can answer yet, but it is the right question to be asking. And in 30 seconds, I am going to bring this all the way down to your kitchen table. Let me zoom out for 1 second and then bring this down hard. Everything we have discussed so far has happened at the level of boardrooms, trade ministries, and energy terminals on the Pacific coast. $22 billion agreements, geopolitical supply chain disruptions, diplomatic positioning ahead of a July 1st deadline. But none of that exists in a vacuum. It lands somewhere. It lands on people. Let me tell you where. Start with jobs. Shell's acquisition of ARC Resources creates immediate demand for skilled labor across the Montney region in northeastern British Columbia and northwestern Alberta, in Calgary's engineering and financial services sectors, and at the Kitimat terminal itself. These are not entry-level positions. These are high-paying, technically skilled trades roles: welders, pipe fitters, instrumentation technicians, project engineers. The Canadian government's spring economic update, tabled in late April, announced a $6 billion program targeting the training of between 80,000 and 100,000 new skilled trades workers by 2030. That program and this investment are not formally linked, but they are pointed at the same labor market reality. Now let me flag something carefully. LNG Canada Phase 2. The potential expansion that analysts at CIBC describe as having a high likelihood of receiving a final investment decision this year would bring an estimated $33 billion in additional private capital. That figure comes from a project description filed with the Federal Major Projects Office. It is a projected number. Phase 2 has not received a final investment decision. I will not present it as certain, but the trajectory is worth watching, and I will be covering that decision when it comes. Move to pensions. The Canada Pension Plan holds significant exposure to Canadian energy assets. When a transaction like the Shell and ARC deal establishes a 27% premium valuation for a Canadian natural gas producer, it creates upward pressure on comparable asset valuations across the energy sector. Pension funds holding those assets feel that in their portfolio values. I want to be precise. This is an indirect relationship, not a direct one. Your CPP balance does not update the morning after a Shell press release. But over time, the aggregate valuation of Canadian energy assets matters to the funds that hold them. Now, here is something concrete. The federal government announced a reduction in Canada Pension Plan base contribution rates from 9.9% down to 9.5% effective January 1st, 2027. For someone earning $70,000 annually, that translates to approximately $133 back per year. That is a verified government announcement. The government's stated rationale is that Canada's fiscal position is stronger than projected. Energy royalties and corporate investment activity are cited as contributing factors. And then there is the Canada Strong Fund, a $25 billion sovereign wealth fund seeded with public capital through which individual Canadians will reportedly be able to invest directly in strategic national infrastructure projects. The detailed mechanics of that investment access have not yet been fully published. Here is the image I want to leave you with before we get to the final question. A 34-year-old pipe fitter in Prince George, British Columbia. He is not reading trade policy documents this morning. He is not tracking LNG futures prices. He is reading a job board. And what gets posted on that job board over the next 18 months is shaped directly and materially by decisions being made right now in Calgary and Ottawa and on the Pacific coast. That is the zoom from $22 billion at the top to one person's employment prospects at the bottom. The macro and the micro are the same story. Now let me tell you how it might end. Or rather, how it might not. I am not going to give you a clean ending, because there is not one yet. What I am going to give you is three honest pictures of where this goes from here. Not predictions, not certainties, possibilities grounded in what we actually know as of May 2nd, 2025. The first scenario is the one where the momentum holds. LNG Canada Phase 2 receives its final investment decision before the end of 2025. The $33 billion expansion moves forward. Kitimat becomes the largest LNG export terminal in the world within this decade. Canada arrives at the CUSMA renegotiation with a documented investment trajectory, a diversified export market, and a negotiating posture that is harder to dismiss. This is the scenario where the signal from Shell on April 28th looks, in hindsight, like the opening move of something much larger. The second scenario is the one where the timeline stretches. Phase 2 faces delays not because the economics are wrong, but because the legal and consultation requirements are complex. Indigenous consultation processes in British Columbia take time. They should take time. Regulatory approvals are not automatic. The CUSMA deadline arrives before the infrastructure story is fully written. Negotiations extend. The outcome is neither a clear win nor a clear loss for either side. It is a continuation, with the energy question deferred rather than resolved. The third scenario is the one nobody is pricing in right now. The conflict in the Middle East moves toward de-escalation. The Strait of Hormuz stabilizes. Qatari supply chains recover. The urgency driving Asian buyers toward Canadian LNG softens. Global LNG prices ease. The external pressure that was quietly strengthening Canada's hand in 2025 becomes less acute. The Shell deal still closes. The infrastructure still gets built. But the geopolitical tailwind that made this moment feel significant, that fades. Three scenarios, each one plausible, none of them certain. Here is what I want to know from you. Which of these three do you think is most likely and why? Is it the momentum scenario, the delay scenario, or the de-escalation scenario that changes the calculation? Tell me in the comments, I read them. And if you want to be here when the Phase 2 decision lands, when the CUSMA review hits its deadline on July 1st, when the pipeline route decisions come out of Alberta, then subscribe and turn on notifications. This story is not finished. It is 60 days from its next chapter.